This week on the Mortgage 101 podcast, we're heading deep into the jungle.
That's right, Manly, and not just any jungle, it's the economic jungle. Every time the Fed rolls the dice, the rules change for the players, and guess what? That's us. And we're left guessing which direction is forward and which direction is backwards.
Hey, if you've been wondering why confidence feels shakier than the numbers say it should, well, this one's for you.
Yeah, I mean, today we're diving in from the jobs data to mortgage rates, from the 50-year loan you've been hearing about, also the K-curve of wealth. We're decoding the Fed's game plan. We're doing that today.
So grab your gear and maybe a flare gun. It's going to be a wild game of Mortgage Jumanji. Hey, Anthony. Picture this. Every time the Fed rolls the dice, that board resets. That's not chaos. That's designed.
Yeah, Manly, because when you can't tell what's forward and backwards, you stop moving. That's the trick. You keep consumers guessing so the game slows down. They're trying to slow down the game, aka economy.
Yeah. Hey, hesitation isn't a bug, Anthony. It's the feature. People hold cash. They stop buying. The Fed cools the economy without even touching the rate. That's all by design.
That's right. And meanwhile, the ones holding the assets, they keep advancing because even in the fog, that motion compounds. Staying stagnant does nothing.
Yeah. Today, we're decoding how the Fed's posture keeps shaping the confidence and how you keep moving when everyone else freezes.
That's right. Welcome to economic Jumanji, where the Fed rigged the game, where standing still is not safe anymore, and waiting for clarity, that's going to cost you the win.
All right, Anthony, little market recap and rate drivers. The dice, they're on the table. Let's look at this week's board.
Absolutely. Let's look at the 10-year Treasury. Starting out, it's up 10 basis points at 4.10%. The 30-year fixed, we're kind of flat there at 6.33. The consumer sentiment, that's over 50%. That is not looking good. The real wage growth, that's up 0.3%. The unemployment, it's a whopping 4.2 to a 4.3%, 0.1 difference.
Hey, that tick made the headlines. Government job sweep. But it's less than 0.1% of public jobs. That's just a rounding error, Anthony. That is a nothing burger.
Yeah, I mean, it's just a buzzword to get the media socializing. The real risk is what's coming up next, which is the holiday season, which usually means seasonal hiring surge. But if a consumer feels the economy is weak, they don't spend. And those jobs, they're never going to arrive.
Hey, one person's spending is another person's paycheck. If shoppers sit out, that's temporary. The unemployment tick, that's going to stick.
That's right. So when the Feds talk about watching the data, its own posture might be freezing the demand that fixes the data. So it's a catch-22.
Yeah. Hey, this caution is meant to steady the ship, but it actually might be just slowing the tide, which is making a mess.
6.
Okay, Manly, let's talk about this fog machine that the Feds have on overdrive. It's making the jobs data revision happen again and again and again. Let's look at August. It's down 20%. Then let's look at September, down 30%. That's not noise. That is a remix by design.
Hey, and the Fed's reaction? Silence. They didn't turn off the fog machine. They set it into arena tour, and that's a lot of fog.
Yeah, I mean, and there's the design, right? Confusion cools consumption. So if people don't trust the scoreboard, they stop spending. And that's exactly what they're trying to do. They're trying to, quote, cool the economy.
Yeah, exactly, Anthony. Uncertainty becomes the lever. No hike, no cut. That's just narrative control. It's all by design.
Yeah, I mean, the inflation's down not because of policy being perfect, but because of the consumers. They were coached into this caution.
Hey, when posture replaces policy, we stop measuring the economy and we start judging the performance.
Yeah, and this is what we've been talking about all year long on how the Feds, they are not following the math. They're following the vision that they're trying to paint. And it's a big difference when you play a board game versus if you actually do it in real life. That's exactly what Jumanji is about. When you play a board game in real life, you make different moves because your life depends on it. The same is going with the feds. They're advising of these things that we need to change as far as an economy, but then when it comes to actually doing them, it's just really smoke and mirrors. And then when it does happen, the feds, they don't have anything to say. So that's where we're like having to scratch our heads going, enough of crying wolf before we call you out.
Yeah. Again, they're creating the narrative and they're following the narrative, but the narrative is manufactured. End of story. It's a marketing play.
What'd you just do?
Strengths: fearless, climbing, speed, boomerang, smoldering intensity.
All right. Policy fog and politics. Add shutdowns, tariffs, and election noise, and the jungle gets thicker.
Oh, man, we are in a thick jungle right now. And I love how the Fed calls itself neutral, but every sentence moves markets faster than Congress can move bills, especially this past couple of weeks. Their agenda is written all over their face, whether they like it or not.
Hey, facts. Consumers feel it. 62% say they're postponing a major purchase this quarter. Whoa.
Yeah, that's right. And it's not prudence, that's paralysis. I mean, spending is 70% of the GDP. So every pause fuels the slowdown, and the feds then call it success. Huh.
They're just feeding us this narrative over and over again, and they are just, by design, holding us back. It's crazy. I'm calling it.
Yeah, I mean, it's like you said in the first segment, they're expecting the market to get better, yet their posture is saying it's not. So it's like, you know that the market fuels and feeds off of the posturing and the views of what Powell and the chairs are saying. So what do they expect if they're showing, hawkish moves, but then when you see what they're actually doing or what they're saying a completely different tune, and it's getting people to a point now where they're like, okay, you're saying one thing and doing another. When are you going to get on the same page with yourself?
Hey, they're creating the fear and the paralysis out of this. We're all sitting here stuck in the mud.
Run! It's a stampede! It's the game! Don't look back!
Now for the real wild card. The 50-year mortgage idea from Trump.
Man, stretching a 30-year to a 50-year, okay, it does cut the payment by 8%, so about $280 on a $500,000 loan. But Manley, what do you think, man? Is this a go or a pause?
Hey, Anthony, this is short-term relief, but it's a long-term hangover. It's roughly $400K extra in interest over the life of the loan. I don't know if that's worth it, my friend.
Yeah, I mean, I think I saw like on The Big Short, they talked about, hey, let's do a 50-year and we can make hundreds of thousands of dollars more and they won't even know it. I mean, it's a Band-Aid for cash flow. It's not a cure for cost of living. Investors, yes, they use 40-year loans, but they do it for leverage. I mean, this right here takes it to a different level. I mean, talk about really putting a Band-Aid on a hemorrhaging wound. The buyers, in my opinion, this is a no pass. This does not make sense. If $200 is going to break the book, you shouldn't be in a home. But $500,000 in extra interest, I mean, come on now. The writing on the wall is this is a no-go.
Yeah, I'm not a fan, Anthony. If rates normalize, we don't need longer loans. We need lower costs. We need lower interest rates, and we need better policy.
Yeah, I mean, if we're at 50, I mean, that's a half a century. In my opinion, you're basically renting your mortgage. You are renting back to yourself with that feeling like you own it, when in reality, you're owning nothing. When you look at that amortization schedule, now I will say, the takeaway here for the viewers is this. If you were an investor and you were looking at this on a short-term view, meaning 1 to 3 years, then I would say, okay, it would make sense until things go in. But you and I both know, Manly, that once people get a 50, they're going to set it and forget it. And that is not economical. If you're doing it short for cash flow, makes sense all day, every day, because if we're doing ARMs or we're going to refinance, which we are, but you and I both know that the normal consumer is going to see a 50 and they're not caring about 30 years from now. And they should be, because this is generational wealth we're talking about. We're not talking about fast and friendly. We're talking about what are you going to do to set yourself up and set your family up. And a 50-year is definitely not doing that.
No. Anthony, I think Mr. Trump, President Trump, I think what he was attempting to do here is to get more people to qualify to buy housing so we can increase the housing market in itself. But that has its own set of problems. If we've talked about it plenty of times, that if we get an interest rate below 6% and we had 500 million or 5 million more buyers, qualified buyers to the pool, it's going to be a mess. Not 500 million, 5 million. If we add all those buyers to the pool, this is in essence going to do a similar type of event. It's going to be a mess.
You know what?
Like home price.
And you made a good point, Manly, because I think the key here is you and I both know that President Trump knows damn well that a 50-year mortgage is not economical. But what you said, you touched on, I think is the underlying meaning. It's a stalemate right now. And so you have the feds who are saying they're not doing anything, and you have the economy who's like, you better do something, and then you have the administration who has got a lot of political turmoil. So I think it was more of like a shock and awe of like, hey, let's talk about it. Let's talk about the elephant in the room. Let's do something now, because if the feds aren't going to do anything, I'm going to do something about it. And as long as people know, when you're listening to this podcast, that is okay in the short term. Because when you look at a 30-year or a 40-year or a 50-year, the first part of the mortgage, the amortization, is going to be the same. You're going to pay the same. It's when you start eating into that amortization, year 5, 6, 7, 8, 9, 10, you start seeing that most of it is going towards interest and not towards the principal. So for the viewers out there, if you're looking for a short term and you want something to happen because the feds can't get off their butts, then yes, this would work for short term. But make sure you're not making it a long-term venture.
Important to point out that your shock and awe perspective has a lot of merit. Just like when he came out with the tariffs and he said he was going to, do 150% tariffs, all those crazy numbers. Those were meant to scare people. He is the master. He is the author of The Art of the Deal. He's asking for 10 times more than he's expecting to get. So he wants to get the housing market moving. If he can get more qualified buyers into the market by coming up with a 50-year amortization, and now your ability to borrow just becomes greater, well, if he actually pulls it off, he's accomplished it. But again,
yeah.
It's posture.
And you just touched on it too, because I mean, look what we're talking about. Look what the nation's talking about. One small Twitter of a picture of a 30-year and 50-year, and everyone's talking about mortgages now. So, I mean, he's accomplished it. He's got it on the radar. People are talking about it. Now, like you said, the art of the deal is you ask for something outlandish and meet in the middle, and you're still a winner. I think that's what he's doing right now. He's like he's taunting the feds, like, yo, if y'all don't get your act together, we're going to make a 50-year mortgage. So they're like, do you want this economical for the buyer, or do you want it, just philosophical? No one's talking about that right now except for us. I think that's the elephant in the room, is the fact that it's on everyone's kitchen table agenda right now, which is what we want.
We're sitting here saying over and over again, the feds have created this narrative, and they're lulling us into this moment that we're in that's not positive. Well, Trump is creating his own narrative to combat it. We need housing moving. So it's
well said.
Shaking the table and saying, "All right, guys, I got the board. Jumanji's coming." He's beating the jungle drums right now. Trump.
100%. He's like, listen, y'all playing by your own set of rules with the same game. If that's gonna happen, yeah, let's make 50-year mortgages.
I mean, again, who knows where this is actually going to go? I don't think we can actually pull this off, but it's good. It's good information. It's good stuff to think about. And if it gets us talking about mortgages, that's important. That's what this show's about. I'm super stoked.
Hopefully you like all the education that you're getting from Manly and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Anthony, it's that time again. The ever popular The Mortgage 101 Rate Tracker.
That's right. Cue the jungle drums because rates are doing their own tribal dance right now. And so let's get this monthly average, a quick take, starting with January. I mean, we started out the gate at 6.64. There was market jitters, post-holiday rebound. But then when we go all the way to March, we were, down 6.54. There's banking fears. There's cool yields. It was looking good. Then we jumped to June, and it went all the way up to 6.94. The inflation, it was cooling, but the trends were still staying around. Going to August, we went up again, 7.02. The CPI was sticking. September, we started going down. That's where we needed. We saw 6.81. We saw improves on the spreads. October, jumped all the way down to 6.31. It was beautiful. November, current as of today, we're kind of sticky at 6.34. We're not seeing it go down. Our historical outlook was we were going to be between 5.8 and 6.2. So the fact that we're touching 6.2, we still got a couple months left of this year. I wouldn't be surprised if we stay slightly under 6.25, but above the 5 mark. That's my take. What's your take, Manley?
Rates are steady, but the sentiment is not. Mid-sixes look fine on paper, but the vibe's pure Jumanji. Everyone's ducking for cover.
That's right, Manley. I mean, what this is teaching us is we have to play offense. Waiting for the perfect condition, that's the costliest move you can make in the game. You're never going to time the market perfectly, so you got to get in, play while you can, or you're going to lose.
All right, Jungle Explorers, you know what time it is.
That's right. Cue our fearless producer, Ryan. Set the ground rules for us, buddy.
You got it, gentlemen. Keep it fast, keep it short, 5 buzzwords, no jargon overload. First up, policy lag.
Ooh, that's the delay between what the Fed does and when we feel it. Like expecting abs after one workout.
Right? I mean, the Fed hikes in spring, your wallet feels it by Thanksgiving. It's lethargic.
Second term today is confidence premium.
That's the extra return investors want when trust is low. I mean, fears cover charge. That's exactly what they're going to charge if they do not see the runway in front of them.
Wall Street surge pricing when Powell looks nervous.
Strategic ambiguity.
Ooh, Fed fluency in maybe.
Yeah, that policy is equivalent to we'll see or hold my beer for a very long time.
Might get warm.
Up next, we got posture inflation.
Ooh, fear acting like inflation. People think prices are rising, so they spend like they are.
Yeah, inflation by imagination. That's how I see it. It's inflation, but it's by the imagination of what they think is happening.
All right, final term for today is asset chaser.
That's the buyer who waits for the perfect timing and ends up paying for the patience.
Yeah, or the one who sat out Jumanji and found out all the good tiles are gone, right? You can't sit out of the game and then expect why you don't have options. You better get in there.
And there it is, folks. That's your buzzword breakdown. 5 quick hits to make you sound smarter at brunch and remind you not to be an asset chaser. Anthony, let's wrap this up with a win because not everyone's stuck in the fog.
No, not at all. I mean, we had a client nearly waited it out, thinking the rates would drop another quarter point or so, but then they listened.
Hey, they finally said, forget it. Let's roll. We locked him at 6.325% on a $550,000 home.
Yeah, 2 weeks later, that same model, it was listed for $15,000 higher. So they built $18,000 before even walking in and moving into it. That's equity that was not timing. It just made sense for them, and that's why they got a big W.
Yeah, they would have missed out on that. Hey, if they would have waited on that payment, that's only $120 more if they waited for the perfect rate.
Yeah, winners don't time the market. They play the market, and this is a perfect example.
Yeah, exactly. They didn't hide behind a tree. They kept moving, and now they're ahead of the stampede.
It's the only explanation. That old game machine must have electrocuted all of us. Now
All right, Anthony, before we close, let's answer that question before it's even asked. No, the sky is not going to fall.
Yeah, I mean, Manly, that's not a pep talk. That's math, right? It's just facts. It's not fear. It's not clickbait. We are talking about sound facts here, not opinion.
Yeah, we keep hearing it. The market's going to crash. Home prices will tank. This is 2008 all over again, and worse. Let's stop that nonsense right now. It's not facts. It's not reality.
No, it's fear-based because the data doesn't agree. If you're flipping, yeah, sure, it's risky in the interim, 1, 2, 3 years. But long-term wealth, that's a different story. And the numbers don't lie. It is showing that you will be in a much better situation than you are now.
Yeah, let's just look at this math, Anthony. Rewind to 2007. All right. You bought a house for $300K, all right? It's a home. We're going to ride out the chaos. You're going to stay put. You're going to live in there until today. Now it's worth somewhere between $550 and $600K. Even peak buyers, they won by staying in the game.
Yeah, and for those of you saying, oh, no, put your money in crypto, it's decentralized. I mean, sure, but so is real estate. And the difference here is ours, you can actually live in. It's a physical asset. It's, you know, it's what stands the test of time.
Absolutely. Real estate is the original decentralized asset. Physical, tangible, and recession tested.
That's right. Crypto lives on the blockchain, right? Housing lives in the real world. And people, they need roofs more than coins, last time I checked.
Yeah. We still have too few homes, too much demand, too many buyers, too many people letting fear drive decisions.
That's right. So the next time your Uncle Louie says the sky's falling, ask if that's fear or that's facts talking.
We want your take. Drop a comment below. Is your outlook fear-based or is it fact-based?
That's right. I mean, real estate, it rewards patience, not panic. That's not optimism. That's arithmetic.
Yeah. Everything we just showed you here, we went back, we pulled the math statistics. This is math, folks. We're talking historical math. We're talking facts. We're not making this up. These are real, tried and true, factual data. You do be the judge.
Yeah, Chicken Little can, jump in the fryer with our last episode because the sky is not falling.
All right, folks, we're stepping out of the jungle for this week.
That's right. And if you learned something or you laughed your way through this madness, make sure to like, follow, and subscribe wherever you watch or whenever you listen.
Yeah, share this episode with that one friend that's still waiting for the perfect timing. That one that's polishing their dice while everyone else is building equity.
That's right. And we'll be back next week with more clarity, fewer vines, and more laughs so everyone could oblige.
More laughs for sure.
Hey, Manly, knock, knock.
Anthony, we're not doing this anymore. We just had this great episode. We used a bunch of historical math to prove that these feds are crazy. Come on.
Yep, we're going there. Knock, knock.
Who is there?
Pow.
Powell who?
Powellese roll something besides the dice already.
Come on. I'm Manly Haynes.
And I'm Anthony Valentino. Thanks for watching the Mortgage 101 podcast.
Please like, subscribe, and share. Send us the next topic that you want us to break down.
And somebody hide Anthony's dice and cup before next week, or I'll send him to Vegas for some real gambling.
If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time. If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it.